everybody. Thanks for joining us for our Business Essentials for Startups panel. Thanks to Twin Cities Startup Week for the week of events. Happy to be here, and I want to thank our Gopher Angels financial sponsors, including Frederickson and Byron, I. Bailey, Choice Bank, and the Home Center here at the Carlson Center. I also want to thank our guests panelists today, Salo, Choice Insurance, and TriNet. As a founder myself, and the questions we see at Gopher Angels, we figured that these business essentials are critical for startups, and it includes topics today on banking, insurance, legal, HR, and investor funding. And they're all top of mind for startups. And our panel today will touch on different topics from their expertise. And at the last half of this hour and a half, we'll take questions, and we will use the chat function to save time and make it a little bit more efficient. So I want to thank you. We're going to get started with some questions to the panelists. I'm going to start with Brett Howells from Choice Bank. Brett, what kind of collateral will I need to pledge to get my bank comfortable with lending the money, and particularly the SBA financing?
Yeah, thanks, Dave. Typically with startup business, banks will steer towards, as Dave alluded to, an SBA lending program. Now, a little background on that for those who don't know: SBA is an agency of the federal government. What happens typically on a startup loan is using the 7A loan program. The bank still lends the funds directly, which is important to point out. The SBA kind of comes in on the back end and provides a guarantee. Most businesses do qualify. You've got to be U.S. based, and you've got to be a for-profit entity, are kind of the two big things. Outside of that, it's really up to the bank to underwrite the loan just like they would a conventional loan structure. The program is funded usually through the guarantee fees, so the bank will charge a fee or finance in a fee anywhere from 2% to 3.75%, typically of the SBA guaranteed portion of the loan, and that's what helps to fund the program moving forward. One of the important things that I would point out to you guys is try to always work with a preferred lender. So we, as Choice Bank and many other community banks in town, have what's called a preferred lending status with the SBA. This is going to give you a lot of efficiencies so that you don't have to go through a third party and then go ahead and send it to the SBA for approval. Typically, the bank can use their authority to approve the loan in-house, of course, subject to the SBA coming in and auditing at any point in time. So that's going to save you a lot of time. Usually the bank then will, if they're a preferred lender, will have an expert team of SBA folks in-house so that you're not going back and forth with a bunch of third parties. Some of the benefits of the SBA program, typically the bank is going to allow for a longer term and a smaller down payment than what you'd see on a conventional loan. The minimums are a 10% down payment based on the total project cost of your startup, and the loan term can go up to 10 years. Interest rates to expect, most startup loans are probably going to be priced at 2.75% over Wall Street Journal Prime. That's the maximum that is allowable to be charged right now. That's equivalent to about 6% in today's market. And the maximum loan size would be $5 million. As far as the collateral that Dave had asked about, typically on a startup loan, unless it's very, very equipment heavy, there's going to be a lack of collateral. The SBA asks the bank to underwrite and try to get to one-to-one collateral coverage. Most of the time we can't get there, but what that means is that we'll look to the personal balance sheet in the event that we have a collateral shortfall, meaning usually the owner or owners would be asked to pledge a junior lien on their house to add some additional kind of skin in the game to help with the collateral standpoint. And I think the one thing that I'll point out again is the bank still has to underwrite this, keeping in mind that there's an unconfirmed stat that unfortunately 90% of startups do fail. So we need to, as a bank, underwrite the loans and figure out, okay, even if the business were to fail, is there adequate fallback? So a lot of times that's why, the personal information is an important piece of that when you're looking at it from a banking standpoint. On top of that, I'll point out, we might get into this in the next question, but business plan and projections, that's basically what we have to look at as a bank when we're analyzing a loan. And so those two things have to be very well thought out and very thorough.
Yeah, thanks, Brett. I mean, that was really useful information for these startups. And I think it's to add to that, in my experience, we've been able to get SBA loans for both equipment and for property. And so, even though I'm with Gopher Angels and we look at every deal as investors and taking equity, there are other ways to finance your business. And I think that was really good information. Thank you. Laura Lee Wicks, I'm going to ask you a question here. How can I afford to build the team I need when I am pre-revenue?
Yes, thanks, Dave. For context for my answer, am I on here? I just wanted to first preface by saying that I work for a firm called Salo, and we provide finance, accounting, and HR resources on a contract basis. So that is the perspective from which I'm about to answer the question. When we work with early stage companies, we see that it's often a very common thought that there's this need and feel to quickly hire up to create some infrastructure, particularly in finance and HR. And what we find by and large is that in that early stage, you really don't need to be hiring up in that regard. But what you do need is expertise or access to expertise in all of these functional areas. And you can do that in bite-sized pieces on an as-needed basis. We see very senior level people that have very senior level HR backgrounds, and they will work with emerging companies, for maybe 2 to 4 hours a month, right? So it's somebody that you have on your speed dial that you can check in with and just sense check the things that you're thinking about and how to proceed. A couple of cautionary notes that we see at this stage too is oftentimes when our early stage companies do hire up, for these teams, they're actually over hiring because you have a need to bring somebody on to help build and develop these functional areas. And that's a different skill set and a more expensive skill set than something you're going to need to maintain that over the long haul. So once you've hired this FTE that can do that build up, when it gets to the maintaining portion of the work, they're not going to be satisfied to stay. So in that case, it's better to bring in bite-sized expertise and have them build and develop your infrastructure than hire a more suitable profile, likely at a lower compensation point for the long haul. And the other cautionary note I would say is oftentimes we see early stage folks bring on a buddy that they knew in college or a friend from a sorority or what have you. And they're bringing on people that they know are smart and they trust and they're familiar with. And what they find is that they don't really have the level of expertise that you will need to do the build and building up of your function and so forth. That's what I would say.
Yeah, thank you. Does anybody have anything to add to that? Justin?
I do really like the point of once you run out of your friends and family, when you got to figure out what the next round of people have to be. But yeah, they make a really good point of having the infrastructure built out and having a true people strategy once you have your product launched, once you have your sales machine ready to go. Well, the next thing you gotta look for is having that people strategy and building out that business. And if you haven't managed a team or ran a company before, it makes it really, really, really difficult. And to add to our point a little bit more, I encourage everybody to meet every great candidate they possibly can when they're bringing people on. They may not be a fit today, but they could be tomorrow. Get them to fall in love with your company, get them to fall in love with your product, and of course, get them to fall in love with your team. And I think that is a great couple building blocks when you're building it out and really bringing a differentiator to maybe some of your competition, some of those larger companies that already have things that you're trying to build out in place.
Justin and Lorley, maybe also talk about, and Justin maybe introduce TriNet, but talk about here's something I hear on a regular basis from startups. I have meager resources. How do I hire good quality people to help me grow my company? So maybe discuss that as well.
Yeah. So my name is Justin Belfany. I am in charge of the technology vertical for the Midwest at TriNet. So essentially, we provide the HR backbone and infrastructure with a technology component and an HR component to small and medium-sized technology companies. Having the limited resources, it seems I've seen more and more startups now that are having a significant amount of resources. So that's generally not the issue unless you're kind of in that bootstrap mode, which I encourage to go that way a lot if you can. But I think it's how you present your company out there to these candidates. What is going to put yourself in a position to why should you work here? What is the potential outlook? What is the culture going to look like? And then will they show the same passion that you do for the product or the service that you're bringing to market today? Everybody's in that talent crunch right now. So I think just doing things different, having fresh ideas in that, and having that potential outlook on what it could look like to work here long term, put things into place like succession planning, not just giving up a bunch of equity or selling your company, but what does it look like for a coder, for instance, to if they want to go into marketing or if they want to learn other things and be integrated in the company on every aspect of it. I think if you start having those conversations with some of these folks, I think that it becomes a better place to work, giving more opportunity, and it's not the same thing every single day.
Yeah, love that. Great thoughts. Thank you. And what I would add to that is, one thing you said was there is a talent crunch today, and we all know that there's a war on talent. We hear it every day. And the offers that talent are getting and the competition to try and land somebody, into a role is really fierce right now. And particularly when you have meager resources and you're at that early stage, I think to do it in bite-sized pieces. You've heard a lot about the gig economy, and the world has exploded in this regard. And there are more people than ever before that really want to work in just piecemeal ways. And it is expertise that you will have access to that you couldn't have imagined. And one thing I will say too is when you bring somebody on, for just bite-sized pieces of that expertise, they might have a scary large bill rate, right? They might say, hey, to have access to my expertise, it's going to be $300 an hour. But if you only need 2 hours a month, that's a small investment to get the right amount of expertise that you need. And when you try and do something on the cheap, a friend of a friend, and you can get them for a bargain price, sometimes that becomes very, very expensive, right? And you might be going down the wrong path as you approach how to build an infrastructure. And then the cost to bring in someone else to fix that and set you on the right course can get expensive. So it can sound scary, some of these prices for this expertise, but to bring it on in small doses, I think makes it very cost effective for you and will help you get on the right path.
Well, that's great information. Say, Dominic Grande with Frederickson and Byron, have you seen when you've structured deals on a legal side, reserving certain equity portion for key players within the company?
Yes, absolutely. And by way of introduction, I'm Dom Grande. I'm a corporate securities attorney at Frederickson and Byron, located here in Minneapolis, and I allocate a significant amount of my practice to the Startup and Rapid Growth Enterprises group. And so we see a lot of startups come through at various stages, we also work on the other side with professional investors. So we get some exposure to both sides of the equation, and both are relevant to your question, because I think when it comes to structuring one of these deals, you obviously want to try to identify the areas where interests align, and that's not always going to be 100%. But an employee equity incentive pool is a very common tool used by companies to hire talent in the early days, especially if they can find individuals who value the equity. That's important. You want to make sure that you value the equity that's in your pool, because there will be a finite amount, and some employees just have a strong bias for cash. And so as part of the hiring process, that's one thing to look out for. But in general, it's a very important component of many startups, and they typically allocate, and it changes from round to round to fundraising round. But you see anywhere from 5 to even 15 or 20% at the very high level dedicated to an equity incentive pool. And again, investors are going to want companies to put this together too. Oftentimes, if you do your Series A round and the company does not have a pool in place, 9 times out of 10, that company is going to say, what I want you to do is create that room, set it aside, and then the pre-money valuation will be calculated based on as if those shares were already fully issued. And so it has implications for pricing the round. And why this is important is if you can get ahead of it and get your plan together, you can anticipate that and get to a point for you're negotiating with an investor. You can say, hey, I have a pool in place. This is my hiring plan. We don't need a bigger pool. So from the company's perspective, at least you can show that you've thought it through and the investor's concern should be satisfied. But yes, the short answer is absolutely. Equity incentive pools are a very important tool.
Yeah, and I think what the investors like to see is people within the company on the startup to have some skin in the game. As you were saying, a high level of incentive to join the group, where maybe they can't provide, a salary level that might be. This would be an offset to that. John Nelson with Eide Bailey, if you want to introduce yourself, then I have a question, and I think there'll be some discussion on this. Tax incentives to consider prior to selecting the type of entity. CCorp over partnerships, for example. If you want to touch on that for a bit, please, and then introduce yourself.
Thanks, Dave. John Nelson at Eide Bailey. I'm a CPA and tax partner with the firm. I'm here in Minneapolis. We're a Midwestern regional CPA firm. So the CCorp versus LLC, which would be taxed as a partnership, I'd come at this primarily from a tax standpoint, in that, to answer that question, which one is right for you as a startup, depends on how long you're going to be with the company in terms of where in the life cycle might you exit. Most of our clients, they're owner-operators, closely held businesses, and more of them, the answer is to be taxed as a pass-through, just primarily because it's a more efficient tax structure. There's a single layer of taxation. For a startup, depending on when you might want to exit, if you think you might be hitting a home run, the answer might be a C-Corp. One, you're not going to be around for the taxation of the profits if you have a quick exit. And two, there's something called qualified small business stock that allows you to exempt yourself from gain on the transaction from a federal standpoint. But you have to meet certain parameters, of course. But that's a very attractive option for a startup to consider if there's going to be an exit in the imminent future.
All right, thank you, John. Anybody else have anything to add on that? Dom, you work with that pretty regularly.
Yeah, and thanks you touched on most of what I would have mentioned when it comes down to entity choice. And I think the only thing that I would add is that the qualified small business stock tax exclusion, it's getting a lot more attention. And when you're thinking about the opportunity to take advantage of it, one potential downside is a purchaser might have a bias for an asset purchase. They prefer to buy the assets of a company when they purchase a company versus buying the stock. In certain circumstances, the advantages are you can more easily leave the liabilities behind. And if there's an asset sale, then you wouldn't get the benefit of the exclusion. But that being said, there, in recent years especially, this has been a more common consideration, and I think there's more of an awareness on the benefits of this, and it might even be making purchasers more likely to pursue a stock transaction, especially if the company has a lot of private equity partners at the point that are very influential, that are really driving the structure of the sale transaction. So I think what it comes down to is thinking about what kind of company you think you're going to have. If it's going to be more of a lifestyle company that you want to draw salary and it's going to be your primary source of income, but you're not really looking at rapid growth, then yes, perhaps LLC or even S-Corp under certain circumstances might be more advantageous from a tax perspective. But the value of the qualified small business stock tax exclusion really can't be understated. I mean, it's the greater of 10 million or 10x your basis, tax-free on a federal level, if you hold the stock that was originally issued from the company for at least 5 years. And so I don't know of a better tax advantage, frankly, than that.
Yeah, and I'm also seeing from the investor side a preference for companies that are organized as C-Corp, because they also get, as shareholders, they get that qualified tax advantage, capital gains exclusion, if you meet certain qualifications. So that's also an advantage there as well. Abby Bishop with Choice Bank, if you want to introduce yourself, and then I have a question. What do I need as a company to open up an account?
Hi, I'm Abby Bishop. I'm a cash management officer at Choice Bank. To open an account, some banks are going to have slightly different requirements, but the following is choice requirements. Most banks will ask for a business application, which will go over the basics of what is your legal entity name, tax ID number, and just asking kind of how you are operating and what kind of services you provide. Next, you're going to need to know your beneficial ownership breakdown. That's a government requirement that all banks are required to collect now. And then you're also going to need to register with the Secretary of State and get your Secretary of State of good standing and your articles. That's just going to show the breakdown of who is an agent of your company and where you're located. And then you're also going to want and need an operating agreement or bylaws if you're more than a single party entity. A lot of people will come in and ask me if they really need this, say like their spouse or sibling, a parent is the partner in their company. And I always let them know, isn't it better to have that down in writing, what you have as legal agreements? And I'm sure Dom can note the importance of having it all in writing, just so there's no confusion down the line if anything were to happen. And then you're going to also need to provide copies of valid government photo IDs for owners and signers. And then yeah, that's pretty much the basics of opening the account. And then I just would go over maybe some details of what would help you operate, and I can follow up with those questions later too.
Thank you, Abby. Having run a couple of businesses myself, the relationship I had with my bank was one of the most important relationships that I had running my business, both in good times and bad times. Having that good, strong relationship with the bank was really essential, and a good, honest relationship, letting them know when things are going bad as well as when things are going pretty well. So I think that having Choice Bank here to help share their thinking on different ways to work with the bank is really critical for startups. I'm going to introduce Derek Lepke with Choice Insurance. One of the things I find is common that startups overlook is insurance coverage. And Derek, if you want to, here's a question I have that we received. Why do I need insurance for my business? Pretty basic question, but please answer.
All right. Derek Lupke, Choice Insurance, Choice Bank. It's a lot of, what Abby was saying, coming in, partnering up with the bank. All the information you're giving her, I'm going to end up using. We're going to piggyback off of each other. But you're protecting all of your assets. You're protecting your business. Having insurance is a big piece of the puzzle, and it's sometimes required. So work comp with the state. If you end up, having employees as you grow, that's going to be mandatory that you carry work comp. There are other coverages as well. If you have a trucking business, for example, there are certain types of forms that you have to have for, long haul trucking, if it's throughout the country, or it's the same thing with many other lines. If you're doing a deal with the bank and you're buying a building, let's say, the bank's going to want to see that you have it insured. So you're going to need the insurance to cover your property. You're going to need insurance to cover, risks that we're seeing out there today. Cyber, for example, is a big hot topic now. People are being hacked and their data, and you could be then sued. And so then you need to have coverage for that possible lawsuit and to protect yourself to get your information back. At the same time, if your company was, let's just say, hacked in that situation, or your building were to have some damages, you would have insurance to cover that, but you would also then have business interruption. And in that scenario, you would have insurance to cover you to keep going your operating expenses after a certain amount of time. That's important. There are many other reasons, depending on your industry. If you have a manufacturing business, you want to protect your goods. You want to protect yourself from, if it's medical devices you're manufacturing, if it's potato chips, whatever it is. If you send out those items and something is missing on the labeling, there are companies going around just looking to sue people for not having the right things listed on the basic labeling. And they're just doing shotgun style mass. Every company is going to be listed on there. It could be $100,000. It's going to tie you up. And if you're starting up, you may not have funds to cover it, big picture, if there is some insurance type of suit that you don't have coverage for. So, in the big picture, it may cost more if you're trying to save a buck up front versus looking at all of your needs now and what are all the possible exposures. We call those also E&O exposures, or professional liability, where it's like it's a mistake that you may make where you're not even intending to, something just happens, and then you're liable for it. So you need insurance for that. You could need insurance for transportation coverage, possibly. If it's inland marine, if you've got a bunch of items being shipped, you want to protect those items if something were to happen, if they were stolen, if the truck rolled. It's cargo insurance. And then you could go with directors and officers. If you have a board you're establishing, they are going to be responsible. That's going to be something that you're going to want, and it's going to be required. You could always spin it off into, obviously, the basics of health insurance, putting a group health policy together. Long-term, short-term disability, dental for your employees. We're all trying to find people out there, good, people to bring on board, and offering the right type of benefits is a big draw. So coming up with some plans there and some options, some solutions makes a big difference in bringing them in. Having an umbrella policy over the top of all of that then is just like a blanket. It's like bubble wrap, protecting your company, protecting you. That's something important to have. I would look at possibly an auto policy as well. A lot of business owners tend to roll in their vehicles in there as well, but it's both personal and business. It's under the business name. That's another form of protecting your personal assets then versus having that vehicle in your name. And then it talk to your accountant, but might be a tax write-off there as well. Those reasons in insurance, it may be required. You have to think about the costs up front. Work comp is going to be something if you're going to be getting employees. Talk to an agent. Figure out what the cost is going to be. That's very expensive depending on the industry you're in. If it's clerical, it's like 11 cents per $100 of payroll. So you can kind of do the math on what it's going to cost you. It's basically nothing. But if you're going to be doing manufacturing, if it is trucking, if it is construction, you're looking at $6 to $12 per 100 of payroll, and it adds up quickly. And as a business owner, you can exclude yourself and save a lot of money. And same thing with you exclude officers as well. So there are some angles there to save some money, but it is going to be expensive, and it is an auditable item as well. So when you sign up and you've got a work comp policy, end of the year, the carrier is going to come back and they're going to say, okay, send in all your payroll records, all your documentation. And if you ended up, having less of a payroll, you're going to get some money back. And if your payroll was much larger because you had a good year, it's great, but then you're going to owe some money. And there's no way of getting around that. So that is a big expense to consider, absolutely. But yes, you want insurance if you have a location, a business, to cover yourself, protect your assets. Somebody walks in the front door and slips, you need to be protected. And looking into those costs up front and planning accordingly and budgeting them is something to consider.
Thank you, Derek. Does anybody have anything to add to that? Nope. All right. Dominic, what are the options? This is a huge question. What are the options for pursuing startup financing? And how do I determine my optimal strategy?
Yeah, so like you said, this is a huge question. We could probably spend 3 or 4 hours on this. So trying to, with this answer, I'm going to try to give a little bit of an overview on some of the primary considerations to determine what route you should be going down and what are the possible routes. We can break it down to, let's say you're an LLC or a corporation. I'll be speaking in corporation terms going forward. You can apply it to LLCs. Say you're a C corporation, an institutional investor is going to expect to receive a class of preferred stock. And what's preferred stock? It's stock with a lot of bells and whistles and rights and preferences designed to protect the investor's investment. And it would be wise to, before you pursue institutional investment, to understand what those typical terms are and be prepared to negotiate against them, with them, or for them. And those terms are typically a liquidation preference. They want their money back first. You'll have information rights, rights to see financial statements, inspection rights, rights to inspect the books and records of the company. Oftentimes, they'll even require a right of first refusal over any transfers of common stock that held by the founders. They'll also look to be getting preemptive rights. So if the company raises money in the future, they want, at the very least, the right to invest pro rata and maintain their fully diluted ownership percentage. So that's the typical terms of preferred stock. But not every company is ready to even pursue that as a possible strategy. For instance, pre-revenue companies, zero operating history, you're really just looking to get off the ground, looking for seed or pre-seed funding. That's not a typical investment for a classic venture capital firm or private equity firm. Most likely you're looking to do a friends and family round. And what does that look like? Typically, you also have the issue of valuing the company to even figure out, well, how am I going to price this stock? I mean, what's the value of this company if I can't do an analysis on the financial statements? We haven't been operating for a number of years. So it's a well-known issue that you have to deal with that conundrum. And the solutions that have been developed are typically convertible securities. So a convertible promissory note is technically a loan. The benefits of this, they stay off the cap table, you maintain control of your company, and you punt on the valuation question. That's one of the primary benefits of a convertible note, is everyone agrees we don't really know how much this company is worth. There's a lot of uncertainties. We need some more time, let it play out. And what will happen is those early investors will convert into a subsequently issued class of security that a future institutional investor or future preferred stock investor would receive. And you receive the same security, but at a discount or at a valuation cap. So you get certain benefits for taking that extra risk of writing that check at an earlier stage. But that's typically the route that you would go for just starting right out the gate. There are there's only two other types of securities I think is worth touching on. You might see what's called a SAFE, a simple agreement for future equity. Very similar to a convertible note. It's just not debt. It's a contractual right to receive equity on certain terms in the future. And again, a lot of the similar triggers exist. I mean, if there's a liquidation event, there's going to be a waterfall determining how much you make out of the sale. But the goal is really to have that friends and family round be a bridge round to the next priced round. And then you convert into that. The only one other unique type of security that I think is worth pointing out, especially because we've touched on the Section 1202 QSBS tax exclusion, there's the issue of this 5-year holding period. So if you are a C corporation, ideally, if you're an investor and also a founder, you want that 5-year period to start ticking as soon as possible. And one downside of a convertible note is that you have to wait until the note converts into equity before that 5-year clock starts ticking. And so depending on when the company might have an exit event that would qualify, that could interfere with the benefit. And one possible way around this is to structure what is technically a class of preferred stock, but that just mimics the rights and preferences and characteristics that you would see in a SAFE or a note. And this is something that we've seen come out fairly recently. It's been tried a couple times. I don't think it's been tested in the courts, but I just wanted to throw that out there. If you're really interested in getting the benefit of that 1202 exclusion, that's something to keep in mind.
Dom and John, you might be able to answer this as well. Can you elaborate a little bit more on this tax capital gains exclusion for C corps and what that actually is? What is that called? And give a little bit of more background on that. We did get a question on that one.
You want to take that, Don? Oh, I can too.
Well, I can start with it, but then perhaps you'll have more details on it. I'm not a tax expert. This just comes up all the time when we're dealing with startups. So I think you'd be better suited to get into the weeds. But I can start with just what it is. And so just to back up, it's basically it's an exclusion on long-term capital gains at the federal level. And again, it's a big one. If you check all the boxes, which we can review quickly again, if you sell your stock after this 5-year holding period, and there's been more than $10 million of appreciation on your stock, you don't pay any tax on that at the federal level. And I understand some states also follow the same structure. I think Minnesota does too, but I don't know that for a fact. And so, of course, you have to deal with the taxes at the state level. But just to understand, this could be a giant tax benefit. And it's even higher if you are a founder and you invest, I guess it would be more than $1 million in your company, because it's the greater of 10 million or 10 times your basis. So if your basis is more than 10 million and the gains reach that amount, you could get even more than 10 million and it just tax-free gains. And so that's ultimately what it comes down to. And I can touch base on just a couple of the requirements, and then perhaps, John, if you want to take it from there. So again, has to be a C corporation, can't be an S corp, can't be an LLC. If you start out as an LLC, you can convert into a C corp and get the 5-year clock started at that point in time. But it has to be a C corporation, has to be an original issuance. So you can't go out there, find somebody that holds stock in a C corp and buy it from them. That will not qualify. And further, another restriction on the company's activities, large redemptions of stock. So the company buying up stock from current stockholders can blow the exemption. So that's a restriction. And I think the theory is they want people to treat this as a long-term investment, et cetera. And they want them to wait that full 5 years for a liquidation event from the perspective of the stockholders. But those are some of the characteristics. I also know you have to have fewer than 50 million in assets, so it's a pretty high bar. Most startups would qualify, but that's what I know about it.
Well, Dom, I think you hit the nail on the head with just about all of your comments. I would add that I'm working through one of these right now with a client. They're in California. It's a Minnesota investment. Minnesota does allow for an exclusion to follow federal. California does not. And I think the answer for them would be California. So it's a bit of a buzzkill from that standpoint. So you need to be careful which state you're located in, where the business is located, to see if you can get that benefit on the state side, because that would be significant, a hit as tax on the gain. I think the other thing was that I learned about that going through the experience was what Dom mentioned. You can start as an LLC and go to a C corporation and not blow that option. You can even be an S corp for a time, but you have to be a C corp for substantially the entire existence of holding the stock. So just a number of things to be careful of. That section is loaded with all sorts of traps. And so if that's something you're interested in, I would strongly suggest getting good advisors on your side to make sure that you run the traps on getting to the finish line on that one.
Thanks, guys. That was really interesting. I will say what I'm seeing at Go for Angels, an increasing interest in seeing companies that we're funding organized as CCorp, partially for the reason we just talked about, but also I think, and John, you might have something to add here as well, but if we're, as investors, investing in multiple companies over a couple of years, then having to wait and manage the K-1s that have to come in from LLCs has become an issue as well for submitting our taxes. I don't know if you have anything to add there, John, or not.
Well, yeah, Dave, that's become an issue for me in managing my personal life with all these deadlines around the extended partnership deadline. Absolutely. That's one of the attractive things about investing in a C corporation over a partnership is that investing in a corporation, no matter the size of it, it's as if you're investing in a share of McDonald's. There's an incoming event and there's an exit, and those are reportable on your tax return, but personal tax return, and perhaps the receipt of a dividend. And that's on a 1099, which would come in the spring. It wouldn't hold anything up from a tax filing standpoint. If you invest in a partnership, you lose control of that timing. And the deadline is September 15th, and most people are good about getting those things done by September 15th in advance of the October 15th deadline to file your personal taxes. But things sometimes tend to go off the rails a little bit with these deadlines. And so from an investor standpoint, the cleanest thing is investing in a C corporation. So there's that. I would say one of the things that you give up when you invest in a C corporation is if you invest in a partnership and the partnership creates losses, even if they're passive, they're carried forward from year to year. And once you generate passive income, those losses you're carrying forward can offset that income. And if you dispose of that partnership interest, those free up as ordinary losses. So it's ordinary. If, on the other hand, you invest in a C corporation, the only character of that income, good or bad, would be capital in nature. And capital losses that are significant don't do much good at all because you can only take those maximum $3,000 a year unless you've got gains to offset them.
All right, thank you. Really interesting. Justin, I have a question for you. Culture. Do you want to touch on why culture is so important for a startup?
Yeah, absolutely. So let's just take the last 18 months, for instance, and in a culture aspect of what we've kind of been going through. Very, very big challenges. And thankfully, I work for a company that has been extremely generous and made opportunities available that that probably wouldn't have been available in different times. So I am very, very grateful for that. And I see, it's the building block of a company. When you have that product and you have that sales machine going and it's time to build, just portraying that is a great place to work, differentiating yourself from your competitors, getting people talking about you, having a great product, having a great team. Then everybody's on the same train, going to the same destination and with the same end goals. And I can't stress enough where, there's people that come to work at where I work, and it's always like we just didn't fit in. There wasn't a good culture. It did not feel like we belonged. And I think with, even with the challenges still that we're facing, I do think it's a good opportunity for founders to have an opportunity that other founders might have not had 10 years ago. I think with the stuff at our fingertips and the technology, you have opportunities to bring other fresh ideas from other states. I've seen that a lot now where people are, we're not going to stay in the Twin Cities. We're going to get fresh ideas from, Kansas City, or, we're going to look in Houston, Texas for that. So you're getting a lot of new fresh ideas in that. And I think it becomes a nice collaborative situation for people all over the country. And then when you do have it all brought together, I think it's a good diverse way of looking at things. Now, when it was just, hey, we're coming to the office every day and it's cool that we have a ping pong table and maybe beer on tap. So I think that those kind of days are gone, and the culture that I've been able to experience and kind of passing on to who I'm talking with as potential clients, I think it's been very important, and I think there's been a lot of good takeaways, and I've learned a ton too. So that would be what I would say on culture. It's probably the biggest building block of having a great place to work and having everybody on the same page when you're building your company.
Thank you. You bring up a good point. With things going remote, and there's some indication that might become permanent or maybe a hybrid. How do you keep a team culture when people are in Houston and you're in Minneapolis, for example?
Yeah, I think it's been a mixture of just new ideas from people all over, where you're just having more of a diverse background of people from different areas that are bringing new ideas. Just certain things that, just different things where we're doing something with these books that we're doing, where people are sending books and writing in journals across the country and on what they've been experiencing, on little things like that in their own community. So I think from a community involvement standpoint, I think it's been from outside and bringing it internally to companies. So, and we're constantly bouncing off ideas, which you would never really have done before, right? That wasn't really, a topic, because everybody was together in the office, and, maybe you had your, team happy hour, your team go to the Twins game, stuff like that, where it's just status quo. And now you really got to think outside the box for it, and having the diverse people from all over and remote, I think there's more things coming to light than ever has before. And I think that's a huge advantage from when people have founded companies or started a service, 10 years ago. So it's been a lot more creative out there, and you're forced to be creative, and you're forced to have that culture because you had no other choice.
Laura Lee, you're from the HR realm. Do you have anything to add to that?
Oops, yes. Yeah. As I was listening to you, Justin, I was thinking, my goodness, culture today is a $64,000 question. And I love what you've talked about getting ideas from people around the country or other areas of your organization. And we are grappling with that as well. As we have employees working all over the states rather, and trying to figure out how does everybody feel part of one common culture. And we're looking for ideas. We're trying to be creative, and we still have a really sexy environment at our office, but nobody's in our office, so that doesn't really matter anymore. But to be open to those ideas, and to really ask employees, they have their thoughts, and we're finding new and different ways to communicate and be together. And I like this idea about the journal. I'm going to have to ask you about that later, but that's where we're at.
Thank you for that. See, Brett, I have a question for you. So you have a startup coming in for a loan. We talked about SBA earlier, but what is it that you're looking for with these new companies when they start building their banking relationship?
Yeah, I'll actually piggyback for starters on, what was just talked about with culture, that, first and foremost for a startup business, we're going off of, like I said, the business plan and the projections. In the business plan, you can easily go and Google a business plan and, check all the boxes and put your generic things down there. But if you get into the weeds and have a well thought out plan about here's how our culture is going to be different, here's how we're going to attract people, especially in a time like right now where manufacturing companies and just about every industry is having a difficult time finding good people to fill their roles. So I think that's huge, is having a well thought out business plan and having a team of advisors. So everybody in this room, you've got your CPA, your insurance, your HR folks, your attorney, your bankers, having that team that you can have everybody kind of review things, give you some inputs, and have multiple sets of eyes on things. So, as far as help with business planning, there are some free organizations out there. SCORE and Minneapolis Business Mentors are two that I would mention that, it's always good to have another set of eyes on things. As far as, financial projections, typically for an SBA loan, we'll want to see at least 2 years of projections, because that's what a startup loan is based on. We want to see that you're going to generate future cash flow to pay the loan off, right? So having a well thought out structure of, okay, you've got insurance expenses built in, you've got, your people costs built in, and you're really thinking about those things and putting assumptions along with those numbers, not just putting the numbers on paper, but explaining why and how you came up with those numbers. So that level of detail is really what separates those 10% or so of successful startup businesses. And that's ultimately what a banker is going to be looking for. On the personal side, you're going to have to be ready to provide your personal tax returns, a personal financial statement to show your personal wherewithal, on top of those things. I think as far as one thing, if you could take away from me as the banker in the room is be organized. Again, go back to the team of advisors. Don't just sit there and say, I've got a great idea, but have this team of advisors that pick it apart so you can really address all of the what ifs and buts of what's going on. Because that's ultimately what a banker is going to ask you. And they're going to want to see that you've thought out, that you've got a fallback plan. What happens when this doesn't happen? What's your fallback plan? And so those are the things that we want to see. Clean, easy to understand financial reporting. That's one of the biggest issues I guess we see in the banking industry with early stage companies, is that it's very difficult to get things done and to provide future financing when we don't have good financial reporting that we can rely on that is accurate. So whether it's as simple as QuickBooks and making sure you're up to speed on that and have someone that can help you manage that and get it set up right away. One other thing I guess I'll point out is when you're doing the projections, one of the things that really stands out is actually having multiple scenarios. So here's your base case, your best case, and your worst case scenarios, so that it shows that you've put some thought into planning for the worst and the best, and then how you're going to react to that in the future.
Thank you, Brett. Say, Abby, I have a question for you. I came in, and it's probably pretty topical these days. How do I protect my business from account fraud?
Yeah, that's a great question. Obviously you want to make sure you're advising your team and employees of how to protect and how to spot basic IT, phishing emails. Just be prepared of how to deal with those main little things that might happen. A fun fact is, according to the National Small Business Association, 43% of small businesses reported being victim of cyber attack. So it's something that's very common to happen, and you want to be able to protect yourself from that. That being said, when you're operating, you send out a check, you're ACHing funds to another company, they have your account information, and you want to be able to protect yourself if that gets into the wrong hands. I like to tell all my customers, it's not if fraud's going to happen, it's when. So you want to be prepared for yourself. And similar to what Derek mentioned about protecting yourself with insurance, we have a package that's focused on securing and protecting your account from account fraud. And we call it our secure account package. So what it is it's two different products, one that will protect you from check fraud and one that would protect you from ACH fraud. That would mean you would just go in with the product and input all of your day-to-day transactions or any check that you had issued. It would ask for check number, payee, date, amount, and when it clears through the system, it would run and match all of that information and make sure that it matches up to what you had input. If anything comes up as a red flag, it would flag for you to review and make you have the decision of if you should pay it or not. It's definitely something that happens. I've had customers who they don't know how, they don't know why, but somebody's taken their check and had hundreds of fake checks made out of it. And the two products of the Check Verify and the ACH Verify is $30 a month, but that could save you a $500,000 check that could clear your account, and it's too late for you to get those funds back And it's really hard to get those funds back sometimes. Additionally, we have a ACH filter, which would you would have approved vendors who regularly debit your account, say your electricity or your rent, and you can set limits for that so that they can't go above that. And if they do, it's flagged to be reviewed. Along with if somebody were to pull something that you're not familiar with, you would also flag that, and you would have that opportunity to decision if they are legitimate or not. So it's a little extra step, but it could definitely save you a lot of money in the long run. And I definitely would recommend it for the smallest company or the largest company because you just don't know. And some people will say to me, well, I don't write any checks off of my account. That's even more reason to have check verify in your account, because what if a check clears? You obviously didn't issue it. That system is there to protect you in that one-off scenario, if it's one time or if it happened 20 times after that. So I would definitely recommend going through steps or talking with whoever your banker is on what they can do to help protect you from fraud.
Thank you, Abby. I want to let the audience know that we are taking questions. If you just want to post the questions on the chat function. We do have a question, something I should be able to answer, but anybody on the panel can chime in as well. What do investors look for? It's not an easy question. I think you always hear the team, but there is more to it than that. The team is important in the sense that we want to see relevant skills. We want to see complementary skills on the team. If you're early stage startup and you don't have the resources to build a team like that, then look at it a board of advisors. So when we look at the team, we include those external influencers like advisors in that as well. It's one thing, for example, when I say relevant skills, do you want to have two tech-related founders, but then no other skills involved, like business development or that kind of thing in the company? So the team is important, but there's some other things. For example, what we've been looking at is the size of the market. What's the total addressable market? What's the serviceable addressable market? You should know that. We also look at, is there a vision for an exit? You have to remember that investors are not in this for philanthropy. They're in this primarily for return, and they want to know that there's going to be an exit. And what's the vision there? Then also, what about revenue? Well, revenue depends on the industry. So for example, in medtech, we don't see revenue in most of the, I'd say 99% of the companies we invest in on the medtech side, because they're going down this FDA path. And it's accepted that there won't be any revenue, but then the question becomes, how long is that FDA path for approval, for example? But if you're in the food business, what we do like to see is some revenue. We like to see some consumer acceptance of your product. We like to see some shelf velocity of the product that's there. So that is important when it comes to food. When it comes to software, it could be either or. We'd like to see for sure beta testing out there with customers that we can talk to that see value in what this software package looks like. Prefer to see those beta tests be paid, but nonetheless, if it's a free beta test, that's acceptable. But even better is if you're already gaining revenue on your enterprise software. So it really depends. So those are some of the things we look at, including maybe some, what the terms are going to be, a decent valuation, a fair valuation, and that kind of thing. So we're going to move on. Are there any questions from the chat room at this point? Okay.
Actually, Dave, there is. What advice do you have for online businesses?
Okay. So the question is, what advice do you have for online businesses? I think that I'm going to open that up to the group, but I can, from the investor standpoint, I think online business is tremendous because you get to know who your customers are versus maybe what's being sold on the shelf. You never know who it is that's picking up that product in Target or some other retail outlet. Instead, you get to build your own customer base, and you get to know who those are and what their demographics are. So that's really valuable. And you also get then a way to speak to those people that you wouldn't get, again, if it's on the shelf in some retail location. So I think online businesses are fantastic. You do want to see some revenue, again, proof of concept, that there's consumer acceptance and consumer demand for what you're building. I also think it's a good stepping stone to getting to brick and mortar, to show that you have built a good online presence and you have a good consumer demand for what you're doing. So it's a great way to start a business. Does anybody have anything else to add?
Online businesses. So yeah, I guess be careful a little bit in creating your webpage. I'm assuming you're investing a lot of money into that. Once you start that process with someone, you can get tied up with them, and it's tough to get away. And then the costs just keep coming and coming and coming. So if you're able to try to shop that out, that's going to be where a lot of your money is going to go in the beginning, and just be mindful of that, and then the security protocols you have in place to protect whatever type of business it is, all of your clientele and their information. That's it.
Thank you, Derek. That's going to lead me to a question. What drives the cost of business insurance coverage?
Sure thing, same thing. So it's going to depend a lot on what type of company you are. So if let's just say, if it's the online business, then that can get spendy depending on if you're collecting a lot of data, credit cards, social security numbers. I mean, it all varies. If you're doing international work, I mean, it's all going to vary. But getting down to the nuts and bolts of it, it's going to be the type of business that you are. It's going to be your payroll. It's going to be your sales. If you own a building, it's the square footage of the building. If you're renting in a space, what other tenants are in there? Is there a bar next door to you? So you've got a greater risk of the building having issues, which would affect yours because you're next door. If it's a building you're insuring, is it, is it sprinklered? I mean, there's a lot of things that go into it. So you have to do some digging. Let's assume that you're doing some transportation. Who are your drivers? Do they have clean driving records? It's going to be a huge factor when it comes to anyone who you're going to be hiring out. If it's some type, again, going back to trucking or whatever it is, it doesn't make a difference. If anyone's driving for you, check those MVRs, possibly before hiring them. The radius, if you're going to be going, what states are you going to be going to? Is it throughout the country? The contents, what do you have that you're insuring? How much of it do you have? Valuation. I would say obviously you're starting up, but in general, then moving forward, if you tend to have losses, that's going to be a factor. If years in business, obviously is going to be zero. So with a startup, a lot of insurance carriers then will charge you more for not being in business for at least 3 years. Obviously, then your pricing will get better once you've been in business, but your experience comes into play. Do you have a story? That's the other thing I work with underwriting. What is the story I'm going to say? You've got this experience. You've done this, you've done that. Here's your business plan. Here are your loss controls, the measures that you put in place to protect your assets to make sure you're not going to have a problem. Those are some of the major issues that will affect your pricing starting out. And then the difference with insurance on the business side versus personal on your home and auto is that is a negotiable price. So when you do work with an agent, have it shopped out. I mean, there are 200 insurance carriers out there easily. So find an agent that has access to multiple carriers, not just one, because then you're just going to get that one quote. And do some shopping. It's the same thing I was just talking about with the website. That's basically it.
Thank you. So I want to encourage the audience to go ahead and submit questions on the chat function. In the meantime, though, here's a question that came up. Do I need a CFO? Laura Lee, do you want to talk about that?
Sure, Dave. Do you need a CFO? And it might feel like you do, but in the very early stages, you very likely do not need that level of expertise. As the entrepreneur or sole proprietor, you will be the one to manage the relationships directly with your bankers, with your tax advisors, with your legal advisors, and so forth. But as things grow and evolve, and here's where I'm going to start sounding like a really broken record, you will need access to CFO level expertise, okay? As you have more investors, as your board starts asking you bigger questions, as things start heating up in the market and your needs for more sophisticated projections and financial information increase, you will need access to CFO expertise. And again, that is something you can get in bite-sized pieces on an as-needed basis. And over time, as your organization and business continues to develop and grow, that CFO will be the one to manage the relationships with the bankers. And if you have debt, make sure that you're meeting debt covenants appropriately and so forth. They will also be the interface with the advisors, with your legal team, and with your tax team. It is highly unlikely you would ever find a CFO that has the expertise of Dom and John, who've been talking about capital structure and tax implications and so forth. They might know a little tiny bit about that, but they will not have the expertise that you would need. So you'll still need advisors available to you, but your CFO will know how to manage those as things really develop and grow. And all of the relationships will grow from that point.
Yeah, I can add a little bit to what Lori Lee pointed out. In some of the high-level CFOs we work with, they're looking to complement their skills with things that I can backfill with, and I'm sure they're doing the same on the legal side with people like Dom. And we're talking about high-level people here, and so you do need to fill your bench with people with a very varied skill set, but acknowledge that there are going to be gaps that are going to need to be filled by various people. So that's all I would add to that.
Yeah, I will say that with the businesses that we developed, we often used a fractional CFO who would come in for, 5 hours, sometimes 5 hours a week, depending on the time of the year. But the point being is that when we made financial decisions, we went to an expert. I wouldn't say we couldn't afford, but we didn't see the need for a full-time CFO. So what we would do, again, is tap into this expertise on a fractional basis. And there are plenty of those out there. I think Laura Lee talked about a gig economy. There are plenty of well-qualified CFOs, and I think, Eide Bailey, I believe you offer those types of services as well. Salo, I think you do the same, where you can get fractional services like that. But there are independent individuals out there that can provide that. And I'll give you an example. When we were trying to figure out, we were in the equipment business, do we want to lease or do we want to buy? What are the tax implications of that? What's that going to do for the long-term impact on our profit and loss statements and future acquisition? So that's a good example of where you would want a fractional CFO to help guide you in making some of these important decisions. So I think that's one option for you. And not only on the CFO side, there are other executives that can help you on a fractional basis. I think we did get a question. How do I build a board of advisors? I'm a new company. How do I contact these people, and what kind of incentive do I have to provide? Dom, I think you run across having to provide a certain amount of equity, possibly for a board of directors or a board of advisors to join your team.
Yes, so this does come up, but I should say it's not universally the case that you have to provide compensation. It really depends on the stage of the company. It can depend on your relationship with the potential members of the board of advisors. It can depend on a lot of factors, but at the same time, especially if you're a mid-sized growing company and you're really trying to attract attract talent from those that have a lot of other things going on at the time. They're going to expect some compensation. Sometimes there's a mix of cash, and again, the cash, there's so much variability because it really depends on the company and what you're trying to get out of that member of the board of advisors, the time commitment, what kind of expertise you're looking for. But that being said, this actually comes full circle to the equity incentive pool that we were talking about earlier. This is one of the many uses for having a pool set aside. It's for exactly this reason, for equity incentives for current and future board members on the actual board of directors, as well as members of the board advisory board, as well as employees, officers, anyone else that might come along current and future. So I don't think I can give a very solid answer in terms of what exactly should you expect to give, because it does really depend. But I mean, some recent examples of some small to mid-sized businesses that were trying to attract talent to their board of advisors, they gave small equity grants of a number of shares that probably was equivalent to 0.5% of the fully diluted capitalization of the company at the time, and of course subject to vesting as well to ensure that they're going to maintain their time commitment. But and so it's typically not huge, but again, you might see giant corporations that'll pay $100,000 to show up to a meeting. It can happen. So again, a lot of variability, but I hope that gives you a little bit of an idea of what to expect.
Thank you. Does anybody else have anything to add to that? I will say that, with Gopher Angels, we find that over 50% of the businesses we invest in, our investor members will often join a board of advisors, and they'll be asked by the company to join the board of advisors because they bring an industry expertise or some domain expertise, for example, like a CFO or HR expertise or something like that. So it's not unusual to find our investor members joining boards of these companies that we invest in. How else do you find advisors getting active in the community here? We have a tremendous startup community. There are support networks all over the city. You should be getting out there and meeting people, not only investors, but your fellow founders, to get ideas, to share ideas. There are places or organizations like Beta MN is a good example. We just finished up the Minnesota Cup, I think on Monday. That's a terrific organization. It's a business competition, but you get exposure to all sorts of advisors in that process, and many of those advisors end up staying with those companies. There are accelerators in town like Generator and Techstars that can also play advisory roles. And so what I'm trying to get at is get out there and get to know these people and network. Again, it's a tremendous environment here for startups and getting their support. I'm going to just sort of open it up. Do we have any questions at this point?
Yeah, somebody has a question regarding business home. So they're wondering whether or not they need all of those team members that you mentioned, or what should they change for a small at-home part-time business?
Yeah, so if I interpret that correctly, what do I need for an at-home business to build team?
Well, because it sounds like a lot of this is towards a larger business. Somebody has a smaller at-home business, do they still need all those advisors and team members? Will that still be necessary?
Yeah, so if you have a small at-home business, and anybody else can chip in, do I need all that help, the team members and so forth? It really depends. How big do you want this business? Is this going to be your main source of income? You might want to decide that first. But it doesn't do any harm to get involved in this network to get new, fresh ideas out there. No, you don't need to build a 10-person team maybe to help grow your in-home business. But you could sure get some darn good ideas out there when you're networking, like I suggested, out in the community. Does anybody else have anything to add on that?
I'll just add in-home business, a few different things. So with your insurance, you can endorse possibly your personal policy to cover your business, depending on whatever your business is. Let's just say it's, well, if you have foot traffic, you should definitely take a look at your policy and just monitor, make sure you've got a high enough an umbrella. You know, it's very simple coverage. Throw $2 or $5 million umbrella, people coming and going, someone, same thing, slips and falls, you're liable. So again, depends what your business is there. There are probably some tax implications on, you know, your office. If you've got a waiting area, if you're having a table set up, how much of your square footage you're using. You know, you can start to look into your expenses and deduct some things for having an in-home business. There's some angles that you can take a look at for insurance purposes, but the coverages, you should definitely make sure that you have adequate coverage if you are having any type of traffic. If not, then take a look at the tax implications.
I'll just add a little bit to, as far as having the team of advisors, I don't think that changes at all. Maybe how you go about it and how you might compensate the team is a little bit different in that situation. When you're talking about a micro, at-home business, you might want to take advantage of some of the free organizations that we mentioned before. Like I said, SCORE and Minneapolis Business Mentors, and in various contacts like that will give you some free advice and free help along the way. Maybe you're not, developing a team of investors or board of directors that you've got to figure out, how to raise funding for, but you still want to have a team of advisors either way.
All right, thank you. Any other questions? Not at this time. I'm going to open it up. Have we missed anything as a panel that you would want to share with these startups and some advice?
One of the things I would touch on kind of harkens back to one of the comments Brad had in wanting to see clean financial statements. And he's absolutely right. When you go to a bank, if there's a question on your financials and you kind of get a murky answer that begs the question, what else is in there? And so you want to be upfront with that item and get your books and records in a good spot from day one. Get your personal things out of that bank account that you're using for your business. Get your financial statements in a great spot. Now moving forward, when we go to a bank, I've been in merger and acquisition deals where the other side just picks and picks and picks at financial statements. And deals fall apart because questions start to arise and we start asking more questions, and all of a sudden the other side gets queasy about what's going on in those records and can I rely on them. So that is paramount in my mind, just to maintain good records.
I can add something extra. Anyone who maybe is in that smaller stage, not ready at this time, or is waiting to see if they're ready to get to this size that they need all this additional things, you still want to, don't downplay it. You still want to set up an account for your business. That's a big milestone. I have a lot of people who come in and have $500 that they just have extra on their money, and they're starting their brand new account that they're for their new business that they're really excited for. Don't downplay the little things either, because it's really important that you mark those little milestones, and not even just opening the account, but looking at how you're going to operate and thinking about that as well. Do you want to write checks and receive checks? Do you want to do electronic payments and receive electronic payments? These are all like little things that I think a lot of people that I work with day to day may not think about until I ask them the questions after they've opened their account. Do you want to mail your checks in to the bank? Do you want to drop them off? Do you want to remote deposit them in? Are you going to need wires? Do you have an accounting software that you're utilizing while you're still small and operating on your own? Do you want that to connect and map over with your bank account? Just small things to think about. And if anybody has additional, is on that stage and has questions about how they want to start, or just get ideas of how they could operate, especially as they grow, definitely connect with me. And I'd love to have a phone call or a Zoom and discuss what I could help you with, whether you bank a choice or not.
Well, I think that's a great start. Do your own bookkeeping. I'm not sure where to go with that question. Um, I personally, it may be good to get a second set of eyes, somebody that does that for a living, a small CPA firm, if that's the level you're at, just to give it their blessing so that you're not missing something obvious, that if that's not what you do for a living, you may not know. And so just to give you peace of mind.
I can add to that as well. We see this a lot with really early stage organizations where the entrepreneur or the sole proprietor is doing their own bookkeeping, and that works to a point. And I think the important thing is to recognize when it's getting beyond the obvious things that you can do, and to bring in some level of expertise for some oversight, or even just to check in with you at month end to make sure things are properly reconciled and stated and you haven't forgotten anything. But it's a very common progression where it starts with you being the bookkeeper, and at some point, the demands and the activity and the level of transactions will outgrow your capability. So recognize that, and then tap into some fractional, piecemeal expertise that can help you. The other thing I would add is as you grow and evolve and add, and you're to the point where you are adding employees, I would encourage you not to underestimate your HR needs. And what I often see with startups is they'll have a really competent, wonderful office manager type person in place, that kind of runs everything, orders office supplies, and also does HR. And what we've experienced in the past 18 months with diversity, equity, and inclusion becoming so much more important, and relevant and on everyone's minds, and the hashtag #MeToo movement, where we're thinking about, is everybody behaving as they should in the workplace, and the COVID procedures and guidelines that everyone's been, daily thinking about how do we comply with those. The stakes related to HR issues are getting really high. And so I would just encourage you to be aware of that and to tap into that expertise on a fractional basis as well.
Thank you. Any other questions? That's it. We're going to wrap up here shortly, but there's one thing that we could touch on. And Justin, I think you might have some comments on this one. One of the things, again, we talked about early on, Laura, you might be able to add to this as well. How do I attract quality people in a startup where I have meager resources? And I think one of the things, because we looked at PEOs, professional employer organizations, and one of the benefits, mind you, that it's costly in some extent, but then it does take away the need to manage your payroll, number one, which can also be very time consuming. Plus, if you make mistakes on paying into the state work comp or make mistakes on taxes, this can come back to bite you in 2, 3, 4 years later and be very onerous. The other thing that you might want to touch on when you're with a professional employers organization is the ability to provide benefits. So maybe describe that a little bit and how that could be valuable for maybe a startup with a handful of employees.
Yeah, absolutely. Well, the first point that you made, the compliance side, right? Compliance is easy to do. I think that's one of the first and foremost things that you should do. I know we've talked about it before. Just do it. It's the one thing that could keep you up at night. Get compliant on it, stay compliant. It's easy to do, and it's the right thing to do. As far as the benefit side, all too often, small businesses are offering benefits just to offer benefits. There's not a strategy behind it. They're doing the absolute bare minimum. And as far as PEOs go, there's a lot of different options that you can do, a lot of different strategies, depending on what your budget is. So it makes it easy for us, because the economies of scale that we can provide, to bring a benefits as a strategy to the table for our small business clients. So I think, and again, to my point a little while ago, I think founders now are in a much better opportunity with the technology that we have to find people in the recruiting and the attracting different people from across the country that they would not have had access before. I think it's just global. People are being progressive, fast moving. You can find people absolutely anywhere right now, and that's probably going to be able to continue on this pace for quite some time. So I think, with the benefits, you bring it as a strategy, and it's every benefit. Some benefits might be unlimited PTO. Some might be medical insurance. Some might be pet insurance. So benefits can mean 1,000 different things on what you want to offer, what you want to contribute as an employer, and then what you want to give access to the employees that wouldn't be able to get on their own by just doing it themselves. So I think it's you can have a lot of fun with it. And I tell my clients and my potential people that are on board with us, have fun with benefits. Don't just do it to do it. Let's have fun with it and make it something that you don't have to change all the time. And it's going to be a good position, benchmark it for your employees. So that'd be my thing on the benefits.
Oh, there we go. I love that. Have fun with benefits. For some reason, benefits never seem to be fun, but I love that. What I would add is if you want to attract people to your organization and you have meager resources to do so, I would encourage you to be very, very clear on your purpose and the impact you want your organization and the work that you do collectively, how that's going to impact the world. And if you can really articulate that, people will come and want to work with you in your organization.